Global headlines are flashing red with escalating conflict in the Middle East, yet the pre-markets are opening firmly in the green. This chart compares two conflicting signals. On the left, the 10-year Treasury yield climbs to 4.58%. On the right, the S&P 500 holds its ground, refusing to buckle. Conventional wisdom dictates markets crash during wartime, but current price action ignores this historical pattern entirely. Investors can no longer rely on the old flight to safety playbook. The market is aggressively pricing in a different reality, and the old rules of correlation have stopped applying. To find the actual friction in this market, we have to look past the global headlines and check the domestic economy. On the surface, things look stable. Weekly jobless claims are holding steady at 215,000. But that steady employment data is masking a shift in consumer behavior. While people have jobs, their household budgets are tightening to the point of exhaustion. This chart of PepsiCo's Q2 results proves the point. The green bars show a penny beat on earnings. But look at the red trend line. North American sales volume is falling. People are simply buying fewer Doritos and Pepsis because of the higher price tags. For domestic stocks, the systemic threat isn't a lack of jobs. It's that consumers have hit a price ceiling they are no longer willing or able to move past. This leaves you with a difficult choice. With tech sliding, consumers pulling back, and war escalating, you have to decide exactly where to place your capital. To evaluate your options, we use the macro exposure matrix. This plots assets against two risks: geopolitical instability on the vertical axis and consumer spending on the horizontal. Mapping an asset here reveals its vulnerability to a sudden war shock or consumer pullback. Protecting your portfolio this quarter requires moving capital into one of these specific quadrants based on the specific risks you're willing to own. The traditional defensive play, consumer staples like PepsiCo, plots out here in the bottom right. It's safe from global war, but heavily exposed to the consumer. The goal of this strategy is to secure reliable dividends while the rest of the world is in turmoil. But the trade-off is significant. You are putting your capital directly in the path of the tapped-out North American shopper. If inflation continues to erode sales volume, these stocks lose their status as a safe haven. Then there's the most debated trade right now, buying the tech dip. Companies like Nvidia land right in the middle of the matrix, with moderate exposure to both axes. The draw for investors is valuation. You can now buy dominant AI infrastructure at multiples we haven't seen since 2019. But the hardware side of the business is struggling. PC shipments are falling, and a memory crunch is weighing on the industry's growth. This creates the risk of multiple compression. The stock price drops because the market is no longer willing to pay a premium for future uncertain earnings. Buying the tech dip today means betting that you can outlast a hardware market that is still searching for a bottom. For a pure geopolitical hedge, you look to the top left: defense contractors, gold, and energy companies like Chevron. These assets provide immediate insulation against Middle East escalation and the shock of rising interest rates. The trade-off is that this allocation offers very little in the way of business innovation or organic economic growth. This is an insurance policy. If global tensions suddenly de-escalate, this quadrant will quickly become a drag on your total returns. Finally, there is the emerging alternative in the bottom left. Biotechnology stocks like Illumina and Eli Lilly are attracting capital because they are largely uncorrelated to the rest of the market. This sector is outperforming right now because biological innovation doesn't stop for consumer budget cuts or Middle East tensions. The catch is idiosyncratic risk. Your investment lives or dies by a single clinical trial or a regulatory decision, regardless of what the broader economy is doing. Biotech offers a way out of the macroeconomic noise, but it demands that you can handle intense, company-specific volatility. The market is no longer lifting all sectors together. In this environment, passive indexing means you are holding on to stagnant stables, while potentially missing the rotations happening elsewhere. To survive, you must match your personal timeline to the specific headwinds we've identified. Here is how those strategies map to your goals. The Tech Optimizer accepts hardware pain to secure long-term AI dominance with a 5-year horizon. The geopolitical hedger is risk-averse, moving to gold and defense to protect against yield spikes, even if it means slower growth. The opportunistic rotator avoids tapped-out consumers entirely, pivoting into the high-volatility, high-reward world of biotech. The market isn't going to wait for headlines to stabilize. You have to decide which of these specific risks you are willing to carry today, or the next rotation will leave your portfolio behind.